Good morning to everybody in WA and good afternoon to everybody else. Thank you for joining us. My name is Michael Haywood and I'll be your moderator for today's webinar on the end of financial year requirements and updates for self-managed super funds. Today you'll be hearing from Katie Timms, who is a director in the Perth Business Advisory Division and also RSM's National Head of Superannuation and Self-Managed Super Funds. During today's presentation, you'll be able to ask questions as you go. However, these will not be answered by Katie until the end of the presentation. Can I please ask you to type your questions into the Q&A box, which you should see down the bottom of your screen. So sit back, relax, and enjoy as I hand you over to Katie, who will begin today's presentation.
Thank you, Michael, and welcome to everyone for today's webinar. For most of our Perth-based clients, you'll know this is a session that we usually run in-house, accompanied by delicious snacks and 1 or 2 glasses of wine. I apologise, it may not be as entertaining without the wine, but we'll do our very best. And welcome to our Eastern States attendees for the first time to this session. And hopefully, if people enjoy it, we can look to run these again in the future to make sure that we're sending out the right information to all of our clients and contacts. So this session, as I said, is one that we do run every year because there's a lot of things that we need to consider before we get to the end of the financial year, particularly with SMSF. So we have exactly 2 weeks left before the end of the year. So we thought it was really timely to cover off on a range of the different things to consider and some of the things that we need to organise before the end of the year. So the things that we'll touch on today will include, first and foremost, our contributions. So looking at what are actually our caps. Those who've had super funds for quite some time will know the caps have been a bit of a moving target over the last few years. And we now have the additional complication of the total superannuation balance to consider as well. So we'll look at what are the concessional and non-concessional caps. The ever fun and more complicated bring forward rule, we'll go through that and what that actually means for you. Couple of new things as well that we'll touch on for this year. So the work test exemption is a brand new one that's never been around before. So whether or not that's something that you can take advantage of. We've got the catch-up contributions, which is also a bit of a new one. It's been around for 12 months, but this is probably really the first year that we're going to see people start to look at it as an opportunity. I'm going to touch on, well, it's not my favourite topic, but it is something I do talk about every year, which is the really important, when is a contribution actually received? Which seems like an incredibly simple question, but given the types of contributions that are received by SMSFs, there are some different answers. So making sure that we've got that right is really, really important. We'll then touch on some of the other things that we need to remember. So pensions, what do we need to look at for that? Our super fund transfer balance cap reporting that we've now got in place, and we've had now for more than 12 months, but I still think it's something that we need to keep refreshing on, and what are the implications for people on that. Touching on leases, so those that are leasing property to related parties, what are the things we need to look at? Valuations, and that's a really big one, particularly this year with the impact of COVID, or maybe, as I should say, what we don't know is the impact of COVID and what that's going to have on valuations, not just for property, but for some unlisted investments, some crypto, what are the different types of things we need to consider. And then one that I think is a little bit overlooked, which is any prior year audit issues. So I know that for those people attending who are SMSF trustees, I know that you would have very carefully read your audit report and management letter last year, but it might be one to dig out this year just to make sure that there's no traps waiting for you when you get to this year's audit and financials. So that's what I'm going to talk about today. As Michael said, I welcome as many questions as you can. If we can't get to them all, then we will send out the questions and responses to you after this to make sure that we have addressed everything. And if it's something specific to you, then please feel free to reach out to me or your local RSM office or contact as well, and hopefully we can answer that for you. So on to the fun, meaty stuff. Contribution caps. Now, start with the easy one, the concessional contribution cap. That one hasn't changed for the last few years. That's the concessional cap. So for those like myself who've been around super for quite some time, this used to be called the deducted contributions. So this includes any employer contributions, salary sacrifice, SG, or any personal contributions that you make that you claim a tax deduction for. And that cap is $25,000 per person. Non-concessional cap, this is where we're starting to get into a little bit of murky territory. This is, again, in old language, undeducted or tax-free contribution. So this is one that's made out of your after-tax money. So an inheritance, spare cash, you know, if you're lucky enough to have some cash lying around. That one comes in from after-tax dollars. You don't get to claim a tax deduction for that one on the way in. That cap is $100,000 per person, but only if your total superannuation balance is less than 1.6 million. And it's really important. I did talk about the transfer balance cap. It's really important to separate the transfer balance cap and the total superannuation balances, because while they both have a cap of 1.6 million, they're two separate things. So what I'm going to talk about here is this concept of total super balance. What is that? Now, this is the value of all of your superannuation interests on 30 June of the prior year. So for this year, when you're considering what is my total super balance, you would need to add up the value of every superannuation account that you've got on 30 June 2019, and that's your total superannuation balance for this year. So this is a little bit of a funny one, because when this concept of total super balance came out, a lot of people found that they had those little lingering super funds that had been around for a while, you know, something that you've had for 20 years, and they keep sending you statements and you think, oh, it's too painful to try and roll it over and consolidate. Now, all of a sudden, it becomes really important to make sure that you know what your total superannuation balance is. Now, the easiest way to find out what that is, if you aren't certain, and it's also really important, not just for this concept of non-concessional cap, but some of the other contribution measures I'll talk about actually do take into account your total super balance as well. So it's not just if you think, I'm well under 1.6, I don't care. It might actually be that you want to use one of the other contribution measures and they have a different cap than $1.6 million. So the simplest way to find out what that is to log onto your MyGov account. Having said that, it's not known to be foolproof, and it really does depend on whether the reporting has been up to date to the tax office. So while it gives you a good guidance as to what is there, you just need to make sure that all superannuation accounts are included. And the other point I'll make on this total super balance is that it includes both your accumulation and your pension interests. Okay, so it's not just what you've got sitting in accumulation, it's all of your superannuation interests on 30 June. Now, if you're 65 or if you're over 65 at the date of making the contribution, so if you turn 65 on the 1st of June and you want to make a contribution now, remember that you need to meet the work test. So this is anyone between the ages of 65 and 74. The work test is 40 hours of gainful employment within a 30-day period. And it's also important to note this idea of gainful employment. It actually needs to be real work. So you need to be paid for what you're doing. So I have had people ask about babysitting grandkids. Unfortunately, unless you're being paid for that and it is actually employment, it's probably not going to cut the mustard. Another one is volunteer work. While it's work, while you're actually contributing, and I think it's a wonderful thing to do, if you're not being paid for it, it's not going to meet the work test. So really important to consider that before you make any contributions. So they're the basics of our caps. However, we then have to look at this idea of the bring forward rule. Now, the bring forward rule has been around for a long time, and what it means is that if you're under 64, on 1st of July of the year you want to make the contribution, you're eligible to bring forward up to, depending on your balance, a couple of years worth of contributions into one hit, okay? So it used to be really simple. It used to just be up to 3 years worth. Now it depends on what your total super balance as to how much you can bring forward using this rule. So let's have a look here. And I've put this in a table because for me, it's one of the simplest ways to kind of explain how this works. If your total super balance is less than $1.4 million, so again, what was my balance on 30 June 2019? Is it less than 1.4 million? If it is, and I'm under 64, I can put in up to $300,000, and that uses up my contributions for the next 3 years. Okay, so it's basically taking 3 years worth of contributions and meshing them into this one time period. However, then we have to look at, okay, well, if my balance is between 1.4 and I've said 1.499, but it's actually 1 cent effectively less than $1.5 million, you can use only 2 years worth of the bring forward and put in up to $200,000, which chews up your contributions for 2 years. Then if you're between 1.5 and $1 less than 1.6, you've got up to $100,000, and that's then just your 1 year cap, and next year you're eligible to make contributions again. More than $1.6 million, you cannot make non-concessional contributions. Okay, it's really important to note that if you have more than 1.6 million, and again, it's on 30 June, not at the time of making the contribution. I did have someone last year look at the market movements and things, and they said, well, I'm less than 1.6 now, also because I've taken out some money, so I can make a contribution. No, it's testing you on 30 June of the prior year. Okay, so before you make any contributions, what was your total super balance on 30 June 19, and what cap is eligible for you? If you are over 65 on 1 July, that means that you cannot use a bring forward at all. You are only subject to the $100,000 non-concessional cap. Okay, clear as mud, right? It's a very complicated system that they tried to bring in, because it means that every time you want to make a contribution, you have to look back and say, what was my balance? How was it fluctuated? And one thing that we do expect to see, the markets did come back after COVID, and then we saw them drop back a little bit again, is we might see some opportunities for people to make contributions in future if the values of assets do drop down. Clear as mud. So what then are the other contribution measures that we can look at? Well, this is a new one, and it was one that kind of came out in the 2018 year, but it was sort of, well, it's going to be useful in the future. We're still not at the point where it's going to be at full use, but it is still something that is there, that is available. So what this essentially looks at is, it says, if your total super balance is less than $500,000, so this is a different one to the 1.6, if your total super balance is less than 500,000, you can go back over a 5-year period and say, well, I didn't actually use all of my contributions during that time period, my concessional contributions, and I can make a catch up and use it all in a future year. Okay, so it's actually, it's a pretty good measure that's out there. It does allow people to, look at a year where maybe you sell an asset, or maybe you didn't have good income for a few years, and then all of a sudden in 1 year, you do have a good income year, you can go back and do catch-ups. So it is actually a really good measure, and I do think it's a good one to have there. Unfortunately, it only commenced on the 1st of July 2018, so you can't go back any further than that. And the reason why that's also important is, in the 2018 year, contribution caps were higher. So when this first came out, I did have a partner here say to me, that's great, I'm going to go back and use up all of that contributions that I can use. No, you can't. So at the moment, you go back, what did I use in the 2018-19 year? Did I use all of my cap? No. Then can I use some of it this year? The other thing to remember as well is that it's not just a measure to get more income into the super fund. You have to actually have taxable income, because this is a concessional contribution. Okay, so if your income is only 25,000, but you want to get more money into super, then you can't sort of use it as a measure to put in more money if you don't have the taxable income to offset it. So let's look at an example just to make this really clear. So in this example, Eric, and I'm looking forwards just to make this more useful to everyone, but Eric sells an investment property in 2022 and he makes a capital gain. Okay, so this is probably the classic example for when you might want to use this. Now on 30 June 2021, so that's 30 June of the year prior to the year that he wants to make the contribution, his total super balance was $349,000, okay? Now, when he goes back and looks at his contributions he made in each of those years, he made $15,000 in 2019, $18,000 in 2020, and $12,000 in 2021, okay? So these were his deductible contributions that had gone into the super fund. So what that means is that he hasn't used up all of his $25,000 cap in each of those years. So in the 2019 year, he's got $10,000 of his cap that he didn't use. And before this legislation, it would have gone lost. In the 2020 year, it was $7,000. And in the 2021 year, it was $13,000 that he hadn't used. So in the 2022 year, when he's looking at, well, how much can I use? He first goes back and says, what's my total super balance? Less than 500,000, tick. Then what's my unused cap? Well, over the past 3 years, going back to 1 July 2018, I've got $30,000 of my cap that I haven't used. He can contribute that plus his $25,000 for this year. So he can actually contribute $55,000 in this year and get a tax deduction. So where you've got those years of higher income, or maybe you're just going, do you know what, I actually just want to put, claim a little bit more of a tax deduction this year, go back and have a look and say, well, did I have any unused cap from last year that might be of some value for me? One other thing that's really important to note is that if you don't use it in that year, so it's a rolling 5-year period. So what if you get to year 6 and you haven't claimed it back in that year, it's gone. You can't then say it's unused. It's in a rolling 5-year period. So something that's really important to note. It's not relevant for right now because we can only go back 1 year, but it's something to remember for future. Another one that's new is this idea of this work test exemption. And there is, I will note there in last year's budget, there was an announcement that they wanted to increase the age you could make contributions without meeting the work test. That doesn't apply until next year, so tune in next year to talk about that one. What I'm talking about here is this one that has actually been legislated and has passed. This applies only for this financial year. So this is the first year we've been able to use it. Now, here's another one where that concept of total super balance becomes really important. If you have to use this work test exemption, you need to make sure that you have a total super balance of less than $300,000. Okay, so again, we need to go back and have a look at what was my balance on 30 June 2019. Is it less than $300,000? Yes, then I can look to apply this exemption. This is designed, or the reason this came out was because sometimes for people who are looking to retire or are selling businesses, sometimes they don't get all of their income until the year after they've actually retired. And if that's past 65, if you're not working, you couldn't make any contributions. What this allows then is that you can make voluntary contributions from up to 12 months from year end after you last met the work test. Okay, so for example, let's say that I retired, let's say I'm 66, I'm not, before you ask, a little bit younger, but let's say I'm 66 and I retired this year. Next year, so up to 12 months from year end, if my total super balance is less than $300,000, I can still make voluntary contributions because I have met the work test in the year prior. The couple of traps for this one, or one real trick, it can only be used once. Okay, so you can't sort of meet the work test, retire, meet the work test, retire. Okay, it really does only apply once, but it does include both concessional and non-concessional contributions. Now, there's some really cool stuff you can do with this around using the bring forward in the year you retire, which I'm not going to go into here, but if you do have a total super balance of less than $300,000 and you met the work test last year and you were worried about whether or not you could make a contribution this year, check in with your accountant or financial planner. This might be something that you can use moving forwards. Now, the thing that I thought was always very simple and straightforward, and yet it's something that we have to cover off on every year, is when is a contribution received? Now, this is going to be less of an issue this year because our 30 June isn't falling on a weekend. Every time 30 June has fallen on a weekend, we've had a problem. We don't have that problem this year. Luckily, 30 June's falling on a Tuesday. But when is a contribution received? If it is cash, it is when the cash hits the SMSF bank account. Okay, so that's really important to note. It's not when it leaves your bank account, it's when it hits the SMSF bank account. Okay, so if you're looking at doing an electronic transfer, please don't leave it until midnight on the 30th of June because it's probably not going to hit the Superfund bank account until 1 July, and that means you've missed the boat. So it needs to hit the SMSF bank account. If you have a retail or industry superannuation fund, be very careful because they sometimes do have earlier cutoff dates for when contributions can actually be paid. Okay, so it's not when it's reported through SuperStream and it's not when it leaves your account, it is when it hits the superannuation fund bank account. What about if you still want to pay by check? This still does happen. And the ruling on this one is that it's when the check is presented to the trustee. Now, we had someone once who presented the check to the trustee. Now, they are the trustee, so it's really hard to argue why it takes you a long time to deposit it. So it does need to be deposited promptly. So this person said, well, I gave myself the check, but then I forgot to bank it until September. And the answer to that is, well, that's too long. It needs to be deposited promptly. So if you give yourself the check on the 30th of June and you deposit it on the 2nd of July, yeah, you might get away with that. As long as you have support to show when the check was written. I have had a client who used this when he was traveling. So was overseas, was in a very small village in Europe, could not get to it, no internet, no bank, no time to do this, wrote himself a check. And then the next time he was in town, which was 4 days later, he deposited that check. That's okay. Okay, so it was deposited promptly. There was circumstances as to why it couldn't be deposited on the 1st of July or the 30th of June. So these ones are the simple ones. Then we get into asset transfers, because SMSFs are one of those joyous entities that can, in lieu of taking cash, can actually take an asset. Now, a lot of strict rules around this, okay? It must be listed shares or business real property, and they're probably the two I'm going to concentrate on. Remember that needs to be at market price, okay? And I don't really want to go too much into what a business property is and all that, because there's a 90-page ATO ruling on that. But if you want to do an asset transfer, and this is probably more relevant for listed shares, the contribution is received when a properly completed asset transfer form is signed. Okay, so the reason that's important is that it's not the date that you write that the transfer happened, and we've had a number of clients tripped up on this, is because they fill out the form, they say, I'm going to transfer in those BHP shares. 2 months ago, the BHP shares took a massive drop, and so I'm going to date it that day so I don't have capital gains tax in my own name. And then they sign the form today's date. Unfortunately, the date that that contribution has been made is today's date. And the reason that's a problem is the price has to be on the date that the transfer form is signed. Okay, so if you're thinking about doing off-market share transfers, make sure that the market price that you're using is on the date that you have signed the form, not the date that the form says what date did this transaction happen. That's actually not how it works for SMSFs. It is on the date that the properly completed transfer form is signed. And if you make mistakes on the form, just be very careful about that as well. So that's all our stuff on contributions. Moving on then to getting money out of super, which is also something that we're always very interested in. So the first one is pension minimums. Now, when we were in the midst of COVID, one of the early things that was announced by government was that all pension minimums are halved for this year and for next financial year. Okay, so that's fantastic. A lot of people were kind of waiting for that to happen. It's what happened when we went through the GFC, okay, and it took a little bit of time for them to build back up. So the government did do that. Now, the reason that they did that obviously was because they didn't want people to be forced to sell assets in a down market just to fund out their pension minimums, okay? So it kind of just gave a little bit of comfort and security. So if your minimum pension was 4%, if you were up to age 65, your minimum pension is now 2% for this year and for next year as well. Okay, and we will send out a bit of a year-end flyer to everyone, just shows you exactly what the minimum pensions are. Very important to remember with minimum pensions is it's not just to the exact dollar or cent. It actually needs to be rounded to the nearest $10. Okay, so we've had some people be stuck with just taking, okay, well, my minimum was this amount, I'm just halving it, and then taking it to the exact dollar. And technically, if that's not rounded to the nearest $10, you've taken less than your minimum. Okay, why is that a problem? Because if you don't take your minimum, you actually might be deemed to not have a complying pension, okay, because you haven't met one of the requirements, and then you forfeit that lovely tax-free income, which is, what we enjoy having when we're in pension phase. So it's really important to make sure that you've got that minimum dollar amount right, rather than just halving it from what you were told maybe initially if it was before the halving came out. If you've already taken more, you can't just put it back in. Okay, so if you were one of those wonderfully organized trustees who, when you were notified of this is your minimum for the year and you took it out in February and then in March the government halved it, you can't just put it back in. Okay, once money is left super, it's left super. If you want to put it back in, you need to meet those contribution requirements that we talked about at the start. Okay, so really, really important for that as well. If you've already taken it, unfortunately, it's just bad luck. You can't just put it back in unless it can be a contribution. The same as with the contributions hitting the bank account before 30 June, your pension must leave the bank account by 30 June. Okay, so same thing. If it's an EFT and it hasn't left your bank account by 30 June, it will not meet the minimum pension requirements. Now, what happens if you do shortfall your minimum pension? the Commissioner does allow you to use trustees' discretion for certain errors, okay? So it needs to be less than 1/12 of your minimum that you've had a shortfall by. It needs to be from a genuine mistake, and you cannot have used it before. So this is the relief is a once-off issue that's available to you. If you forget your minimum pension completely, you cannot use it. The relief is really there for maybe if you were paying yourself 12 regular monthly payments and the last one was missed for whatever reason, if you did a rounding error, if your calculations were slightly incorrect. You know, it needs to be that kind of error, and it needs to be less than 1/12. If you've had that happen, what your accountant will do is accrue the difference and tell you you need to now take this extra $10 out that you've missed ASAP to meet that requirement. But if you've used it once in the past, you cannot use it again. Okay, so it's really, really important that that's the case. There's a flow-on impact for not taking your minimum pension as well. And that is because that is due to this idea of transfer balance account reporting. Okay, so this is something that came in 2017, I think, which feels like an eternity ago. The ATO brought this in as because they are very well aware that accountants, when we do super fund accounting, get to the end of the year and say, I wish we could have treated that as a lump sum, or we could have maybe done this a little bit differently. So it's a move to real-time reporting. That's what they're trying to get to. So at the moment, if you have a pension, okay, you need to report certain activities to the ATO, and you either need to do that on a quarterly basis or you need to do that on an annual basis. And whether or not you do it quarterly or annually depends on your total super balance. But it's not your total super balance, it's the members of the fund. Okay, so if you had, let's say that there's 4 members of the super fund, 2 of you are in pension phase and your balances are less than $1 million, but there's one member, maybe they've only got 600,000 in this super fund, but they've got 500,000 in another super fund. Their total super balance is more than $1 million. You need to report your pension activity quarterly. Okay, so I don't really get why they did it that way. I can understand if it's your balance, but it's not up to me to determine what is right or wrong in this. This is what we're dealing with. The benefit is that it is a once-off test. When you commenced your pension, did any member of the fund have a total super balance of more than $1 million? If yes, you will forever report quarterly. If no, you will forever report annually. Okay, so it's a really good incentive to have everyone less than 1 mil at the start, and then things can grow, and you know we can take advantage of it at that point because it's a fixed reporting regime. So what do you have to report? New pensions. If you're using an excess lump sum strategy, you know, so where instead of taking your excess minimum pension as a pension, you take it as a lump sum. There's a whole range of paperwork and rules around whether or not you can do that. So new pensions, excesses over the minimum. Pension started with new contributions, and that's probably an important one for this quarter that we need to be aware of. Or if you're ceasing a pension. Okay, so they're the things that we need to report as part of this transfer balance account reporting. Now, one of the things when I was talking about failing to meet your minimum pension, if you fail to meet your pension and you can't use that discretion, your pension is actually deemed to have ceased. Okay, so you lose your tax-free income and your pension is deemed to have ceased, which means you need to recalculate your balance and report that to the tax office under this transfer balance account reporting. Why is this a problem? Because if market prices have dived, you might not be able to get as much money back into super. Okay, so I haven't written this one down, and I apologize for that, but here's some broad numbers for you. If I've commenced my pension with $1.6 million, that's my transfer balance cap that I've used up, and I can't put any more into pension. It can grow, but I can't start any new pensions. So that's what is my transfer balance cap. If my pension, when I fail to take my minimum, has dropped to 1.2, that's the credit I report back to the tax office. So when I say I've stopped my pension, they give me a credit back of 1.2 million, but I started with 1.6, so I'm short 400,000. So when I want to recommence my pension, I can only recommence back up to 1.2, and if the markets come back more than that, I can't put any more in there. Okay, so long story short, please take your minimum pension. If you're going to have any issues or concerns with that, please do talk to your super fund accountant just to make sure that you've covered off on what you need to cover off on. Now, Really important to note is that if you are on quarterly reporting, you'll have a 28th of July reporting deadline for activity between the 1st of April and the 30th of June. So if you're making contributions between April and June that maybe you used to start a pension with, that needs to be reported to the tax office by the 28th of July. Okay, so just a heads up to remember that with your transfer balance account reporting. If you're on annual, it's fine. You've got until the lodgement of the tax return. What else do we need to look at? Lease considerations. This is more questions than anything else, but the overlying issue here is that if you are leasing a property to a related party, you must comply with, or you must have a lease agreement for a start. Hopefully, most of the RSM clients don't have this as a concern. You need to pay the lease, and B, you need to have a lease, and B, you need to pay it according to the lease agreement, okay? This concept comes back to you must be dealing on an arm's length basis with your related party tenant as you would with an unrelated party tenant. So if your lease agreement asks for monthly payments and you forget and you pay one payment at the end of the year, your auditor might notify you with a bit of an issue and say, hang on a minute, you haven't complied with your lease agreement. So make sure that A, you know what your lease agreement says, and B, you do it. Are you paying at market price? Does your lease agreement call for a rent review or a CPI increase? Now, I know acknowledging we're in COVID times and we've had all of these rent relief measures offered. If you're offering rent relief, it needs to be documented. Okay, so you need to make sure you've gone through that process. RSM does have documentation available to assist, and we can help you through that. If you have offered rent relief and you're now looking back and going, yeah, I forgot to, I forgot to document, I forgot to tell anyone, I just did it. Okay, we can help you through that process, but it does need to be documented and justified. So you need to say, why did I need this relief? And if your lease agreement calls for a rent review or a CPI increase and you don't want to do that because of COVID, again, you need to document it. So you need to be aware of it and you need to document it to make sure that it's covered off, as you would with any unrelated party. Now, I've sometimes had people say to me, I would let a related party have 12 months off. Personally, if this was my retirement fund, I probably wouldn't. I would like them to pay or document, okay, this is why you're not paying, this is why I'll let you have some time off from it, all those sort of things. So you need to make sure that that's what you're considering when you're entering into, when you're reviewing your lease arrangements for the year. The big one, valuations. And this is I'd say this is a fun one. It's not, this has been the biggest headache that we've had over the last several years, and that's including transfer balance cap times. So that's really saying something. Contrary to what is popular belief, SMSF assets need to be revalued to market every single year. Okay, that is actually the legislation around this. SMSF assets need to be reported to market every year. This has been around for quite some time now. Okay, so it's not a new thing that I'm bringing out this year. It is every year assets need to be revalued to market. There is this, was this industry view prior to this legislation coming out in 2015. So again, we are talking a while, is that you only need to value property every 3 years. That still lingers for some people. That's actually not the case. The rule is it's every single year. Now we tend to take the policy of, if it's been, if you got it valued within the last 2 years and there's been nothing happen, particularly for our farming clients, that own property, it doesn't tend to change within 2 years. We usually say, unless there's been something significant to show why it needs to be revalued, we don't need you to get a new one. But it has to be within a 2-year time period. Is COVID a significant property movement? And that's really going to be a question that we don't know. We've talked about this a lot here, and our general approach is going to be, until we kind of see what is the, what is the impact on the property market. Sitting over here in WA, we're actually not really seeing too much of an impact at all. But is that going to be the case in 3 months' time when, or whenever they decide to end JobKeeper and all of a sudden people can't, pay rent? Are we going to see more movements in both the commercial and residential property markets? I know that, other states are having a different impact. They're already seeing people not be able to pay their rent or, looking to move. So it's really hard to answer whether or not you're going to need a new appraisal. And the second component to that is, what is market value at the moment? Because market value is technically an agreed price between a willing buyer and a willing seller. If there are no willing buyers or willing sellers, how do we determine what market is? So that's going to be a bit of a fluid thing that we're going to have to work through. My current approach is I'm just kind of letting it sit for, unless I really need to finish financials or do things within the next 4 weeks, I'm just kind of letting things settle for a little bit and see where the market goes. Let's wait and see, what's happening in your state, your location, in what type of property it is. So commercial might end up different to residential. Farmland, is that actually going to change too much? Has that been impacted by COVID? And are you going to be able to find someone that's going to be comfortable to give you a valuation? Because they're facing all of the same questions that we have about the uncertainty of we just don't know. So the overarching rule is things do need to be revalued every year. Maybe have a talk to your accountant, or they can give you a little bit more guidance as to, yes, you do need to, because maybe you are 3 years old or 4 years old in your valuation. God, I hope not 4 years, but you might be a couple of years old. Or they might say, do you know what? No, we don't need one for you because you're a farmer, in the Great Southern of WA, and we don't actually think there's that much difference now, and you got us an appraisal last year. That's property. What happens then when we get to unlisted trusts or companies? These are very difficult to have to address and deal with. If you have an unlisted trust or company, quite often shares and units aren't traded. So how do we actually determine what is market for those? There are a range of different options we've got. We look at, has there been a trade within the last 3 months? If not, okay, we can't use that. If there is, was it a trade between related parties? Because there can be, sometimes people transfer to kids, to siblings or to, friends. Was it actually an arm's length transaction, and can we use it? If we then want to say, okay, well, what if it's an unlisted trust, a property trust? What are the assets within that trust worth? And then do we, say, okay, if the assets are worth $1 million, there's, 10 investors, each investment's worth $100,000. Okay, do we know that all of those assets within that are worth $1 million? Have we verified them? This becomes a minefield. Please be nice to your auditors if they are asking you for things like this. They do not want to have to go, I'm an auditor as well, I don't want to have to go through this every year, but unfortunately, that's what the ATO requires us to do. In addition, there has been some cases recently where auditors have been sued for not correctly verifying the market value of the assets, and the trustees have come back and said, well, you didn't tell me that this, it's been valued at $100,000 on my balance sheet, but no, you didn't tell me that it was actually only worth $1,000. Okay, so there is a lot of responsibility around auditors. Please be nice to them. They're not trying to be difficult. They are just complying with what the rules are, and I promise you will like them if in the event that investment maybe is not worth as much as you think it is, and they've dug a little bit into it and said to you, hang on a minute, maybe you need to look a little bit closer. The other one as well that I haven't noted here is that cryptos. If you do have cryptocurrency, and we do have a few around the country, I don't know if any of those people are here, you need to be able to evidence that on 30 June. Okay, so if you've got a wallet, take a snapshot, and you need to be able to verify the price on the 30th of June as well. Okay, so that does fluctuate. You need to be able to evidence that. And last but not least in this is prior year audit issues. So every year you should get from your auditor your audit report and a letter. So they should send you a letter every year. Now, look, I'll be honest, if I got that letter every year, I'd probably just file it away and maybe not read it as closely as I should. It is actually pretty important that you do read that. 99% of the time, the letter will say there's no issues and I've got nothing to report to you. If that's the case, skim it, file it away and save it for future. You don't need to worry about doing anything. But if the letter does say something, it's actually really important that you do read that. And the reason for that is that the ATO has mandatory reporting requirements, okay? And what that means is that if the auditor has sent you a letter and said, hey, you haven't complied with your lease agreement, you need to comply next year, or hey, you need to get a new valuation next year for this asset, or hey, your bank went into overdraft, you need to make sure that doesn't happen again. Because if it's a repeated issue or an uncorrected issue, the auditor has no choice but has to report it to the ATO in an auditor contravention report. That sounds very scary, and the letter you get from the auditor, if they do have to do that, sounds horrendous, and it says, you're going to be taxed at 47% and all of that sort of thing. And that is the big stick the ATO has around this, but it may not be that bad. You might get trustee penalties, but no one wants penalties if they can avoid them. So double check, what did that letter actually say? Does it say you need to fix this for next year? Does it say, please note I didn't have to qualify you, but if you do any future breaches will mean that I qualify you, and it's something you can fix, please fix it before 30 June. It's a simple way to make sure things go very, very smoothly. You don't have to have fight and hate your auditor. It's just one of those simple things that you can tidy up. Is it something that you can tick off and make it a smoother audit process? If you're not sure, if you've got the letter and you say, I don't really get it, what do I need to do? Check in with your SMSF accountant. Hopefully they've held your hand through the process to say, hey, you do need to fix this. And if they haven't, maybe they'll reach out to you in the next week. But if they haven't, if you're not sure, check in with them and they'll be able to help you. There are some things, some of you, if you've had your audit done since whenever we had a global pandemic, okay, you would have had a note in your management letter to say, there has been an event subsequent to the reporting deadline, which basically means that, look, we've had a global pandemic issued. We don't know what the impact of that on your financial statements is, and we're only reporting on what existed at 30 June, and this could be very, very different now. If you've got that letter and if that's the only paragraph, you don't need to take any action on that. That's just us letting you know that don't look at your super fund financials and go, oh my God, it's amazing, I'm worth $2 million. Because by 30 June the next year, given the impact of COVID on the markets, you actually might not have that. So in summary, and before we get to the questions, and I can see there are some questions there. First one, make sure you know what your contribution cap is and make sure that your contribution is made by the 30th of June. If you don't know how to tell your total super balance, or if you're not 100% sure on your contribution cap, please reach out to your super fund accountant or your financial planner. They will be able to talk you through it. And I guarantee you it's a conversation that I personally, so if any of my clients are on here thinking, I don't know what it is, please ask me the question, because I'd much rather answer the question now than have to deal with the implications of getting it wrong later. As I said, make sure you know what your total super balance is, okay? Are there any obligations you need to be aware of? Should you be reporting your transfer balance cap issues on a quarterly basis? Are you eligible for the work test exemption? Are you eligible, for the catch-up contributions? So first thing really, it's what the government is encouraging in this is they want people to know their super better. They want people to be more engaged with it. They want people to be aware of what is around. Are you complying with your lease agreement with a related party? Okay, so it might have been a document that you went, I had to do it because my auditor made me, but it is an important document. And if there's clauses in there that are binding you to weird things, then it's really important that you read that. Have you documented any COVID relief? Okay, we have the benefit of being an SMSF is you do have more time to get that documented, but remember, it does still need to be done. Do you need new appraisals for any of your assets? Okay, so did your accountant last year say to you, all right, we're getting outside of the range, for next year you need to get one? Please maybe have a look at that. If you're not sure if you still need one, again, reach out. We actually do like talking to you guys. Have a conversation about it. We might be able to make it a much smoother process when we get to doing the accounts than having to say to you at that point in time, oh, by the way, we need a new appraisal. Can you go and get one? It might slow down your refunds. And the last thing is, are there any last minute issues that you need to address by the 30th of June? Okay, so are there things, in your audit letter that needed to be rectified? Are there, documents that needed to be done by the 30th of June? Have a look, give yourself some comfort that you're not going to get a nasty letter from the auditor next year because you didn't read, the report last year. And that's the end of my presentation. Michael, I think we might have some questions.
Yeah, so thanks for that, Katie. We've got a few questions, so we'll get cracking on them. The first one we have is, if we go over the non-concessional contribution cap in a financial year, what are the issues? Can we just withdraw the excess over the cap?
Unfortunately not. Well, you can, but it's not going to fix the problem. So there's a couple of things that happen there. One is it's actually a breach of the contribution rules because the SMSF can't actually accept the contribution if you make that. So you've got that as an issue. And the ATO will actually also issue you with excess contributions tax. Now, there's and also, you're not actually just allowed to take the money out. They will actually provide you with a release authority to do so. Unfortunately, it takes them a while to do that, and the excess contributions tax and charge they will issue you with will be from the date you did it or reported to the date they actually notify you. So much easier to not do it. But if you have, just be aware that there will be excess contributions tax levied on that amount.
Awesome. The next one we have is, if we use the bring forward rule for the next 3 years, does that mean we can't make any more contributions until the 2022-23 financial year?
This is actually a really funny one, because whenever I do these, I get out my paper and my pen and I have to map it out, to go, okay, if we do it in the 2020 year, that uses your contributions for 2020, 2021 and 2022. So correct, you can't make any more non-concessional contributions until the 2023 year. And what's also really important to note is, what is your total super balance at that date? Okay, it's not all, we used to have this benefit of plotting out contributions for the next, 15 years. We can't do that anymore, because we need what is going to be our balance on that date. And if it goes up, you might not be able to be eligible to make contributions anymore.
Cool. The next one is, how do I know if I have any room for catch-up contributions?
You should talk to your RSM superannuation specialist accountant in the first basis. And if you're not serviced by RSM, we'd also love to help. No, look, your tax accountant should be able to log on to the tax agent portal. They can have a look at what your total superannuation balance is. And in theory, they should be able to say to you, this is actually the contributions you've used in prior years. Again, there's been the odd occasion where that information being reported is not 100% correct. The ATO is absolutely working on that, but your tax accountant is the first place to go to see whether or not you're eligible to use catch-up contributions.
Cool. So the next one, I think you'll enjoy. Someone has asked, can I withdraw all of my super as a lump sum before 30 June 2020?
Well, it depends. To be able to withdraw your superannuation, you need to have met a condition of release. Now, condition of release, God, we do a whole other session on how to access your super. In very short, if you're over 65, my answer to you is yes, you can. Is that the right thing for you? It might be. You might want to have a look at, the advice on that, whether or not it actually is the right thing for you. But if you're over 65, yes, you can. If you're between 60 and 65, then you need to have met a retirement condition of release, which again, it's a whole big topic. I don't want to chew up my next 10 minutes just talking about retirement. So if you want to do that, again, maybe reach out and have the conversation about, can I access my superannuation? If you're over 65, yes, you absolutely can, but just be careful, because once it's out, to get it back in, you need to have a look at the contribution rules.
Cool. If I have already withdrawn my full pension, can some of it reduce my total super balance to allow me to contribute again?
Oh, well, absolutely. So when we look at what is your total super balance, if you had, I'm going to use round numbers because I'm an accountant, I'm terrible at maths. If you had $1 million in super and you drew out $100,000, that does reduce what you've got in super. Now, I suspect that question, I'm just going to answer that question as it is. I'm not going to read into it. So the short answer is yes, it will help reduce your total super balance. And then, but it depends on market movement. It depends on your asset values at 30 June. So it helps. It might get you to be that $1 less than 1.4 million to let you do a bring forward, but it's almost impossible to know what that is if you have any kind of listed investment where market prices are going to fluctuate, to know whether or not it's going to get you under that. If you've only got cash, then yes, it's a lot easier to say, yes, I had $1 million, I've taken out 100, therefore my balance is $900,000, give or take tax calculations and that sort of thing.
Cool. I think that we're also referring to the with the pension minimums being halved, how
Yes.
that affects it. Whether if it was before the change, would they still be able to use it as a T-bar event?
So that was the question that I didn't really want to, it wasn't the question that was asked, so I didn't really want to get into that. And if that was your question and I haven't answered it, please reach out to me to correct it. The short answer to what Michael's asking is, I mentioned earlier this idea of a lump sum strategy. So one thing I said is that your minimum pension doesn't reduce that transfer balance cap 1.6 that you've got, but lump sums you commute or take out of there do. Now, if you've taken your minimum pension prior to the pensions being halved, you can't treat half of that as a lump sum. Unfortunately, it's just one of the rules that we've got. If that confused you, please just let that fly over your head. It's quite a technical accountancy thing to worry about. But if it is something you kind of understand and you'd like to know more about, please just reach out and I can map it out for you specifically.
Cool. So someone has asked, when did the quarterly reporting happen on fund balances over 1.6 mil when pensions commenced?
Yes, well, so it was basically, so when did the quarterly reporting happen on fund balance? So it was actually over $1 million. So the quarterly reporting comes into play if your balance at the commence, or if anyone in your fund had a balance of more than $1 million at the time you started your pension. Now, you only need to report those specific events that I mentioned, but if it does happen in that quarter, then it does need to be reported by the 28th of the month after the end of that quarter. So for 30 June, it's by the 28th of July. For the September quarter, it's by the 28th of October. That has been around since the very beginning. The ATO has taken a bit of a lax view for the first 2 years of it, really, is to say we understand it's a new process and people will report late. We expect that to come to an end quite soon.
Cool. So the next one's kind of a question and a statement at the same time. So it's saying, should there be a blanket rule from the ATO saying that all properties need to be revalued no matter what, as this would
Yes.
avoid confusion?
I would love, well, sorry, look, it's a tough one because my gut instinct is to say yes. But the real answer is they've actually done that by saying assets all need to be revalued every year. It's only accountants trying to interpret it and give people some leeway to say, well, maybe you don't need to revalue that property this year. Because, it's not fun to have to go to your real estate agent or to get another appraisal every year, and people do charge for it. So the blanket answer from the ATO is everything should be revalued every year. It's us creating the ambiguity by saying we're trying to give you a little bit less obligations as to say you don't need to have it done. So if everyone would like to have it, to organise that every year, I would make my life a lot easier. But, unfortunately, it's not always the most practical. And, we've got clients that have assets that it's difficult to revalue every year. We have a client that owns a station up in the middle of nowhere. And to get someone up there to value it, they need to fly them up there. Now, that adds a lot of significant cost, and the value actually doesn't really change that much. So it's a little bit of a tough one as to what is the right approach to market values.
Yeah, cool. So the next one, which might be a bit complicated to answer, just online, is if the related party lease requires CPI increase at 1 July 2020, do we just ignore it and apply the CPI increase in October 2020 once the rent freeze is over?
Yeah, look, that's a tough one to answer because it depends. It depends on whether you've applied the code, properly, because that is really guidance. It depends on the industry. It depends a little bit on what's going to come out within each state. The generic answer would be, yeah, I wouldn't just ignore it. Again, it would need to be documented. So to say this is between both parties, we're not applying the CPI increase, until the October period. But the generic answer would be yes, we would suggest that it doesn't need to be increased on 1 July, but it should actually be documented as part of the process. Why?
Owned by two separate self-managed super funds, is each party allowed to use different accountants and auditors?
Oh, absolutely. Absolutely. I mean, look, each SMSF, regardless of investments, is entitled to use whoever they want. It will create complications. And I can see the next question, I suspect, is a flow-on, which relates to, sorry, Mike, I'm jumping in, but I'll just, the next question was really, if different auditors are used, does it matter if they value the same property at different values? No, it doesn't matter, but it depends on the evidence that they've got to support that market value. So the correct answer on what is market value and how do you determine it is it needs to be supported by enough objective data that any person would come to the same conclusion. So if you've got a one-liner from an agent that says, I think this property is worth $400,000, that's actually probably not going to meet the requirements. It should actually have, this is why, this is the size of this property, I've applied this rate or however. Michael, not moderator Michael. Michael, if your question was really around, like, if you choose a different spot in the range, well, technically, no, it's not a problem if you do that. So if you have an appraisal that says, I think this property is worth between 400 and 475, and one uses 400 and one uses 475, it's within the market range that's been given. So as long as the auditor's comfortable with that, it's not wrong. You know, it's just, that's what the valuers said.
Got a few minutes to get through them all, which is great.
Okay.
The next one is, what age do you have to start? What age do you have to be to start drawing down super?
You never have to start drawing down super. This is something that was around, oh God, still when I started, 2015, this change. There used to be a compulsory drawdown. So it was a compulsory cashing. Once you reach 65, if you weren't working, you had to draw down. That is gone. You can leave your super in accumulation forever if you want to. There is no requirement to start drawing down on it at all. If you do start drawing a pension, then you have to draw a minimum every year. But if you're not in pension phase, there's no requirement to draw it down if you want to leave it there.
Awesome. And the last one is work contribution age 65, yet retirement age 66 and a half.
So retirement, you need to remember, is different for age pension purposes versus the superannuation legislation. So there's two different definitions there, which make it a little bit complicated. For superannuation legislation, once you hit 65 and you are eligible to draw down on your superannuation, it's different to what the government deems is age pension age. They say you're not eligible to draw a government age pension until you hit their age. That's not the definition of retirement. From superannuation purposes, 65 is the magical age from where, at the moment, it'll change next year, is that's 65 is retirement, and it's also the age that you need to meet a work test to be able to make a contribution. So the 66 and a half relates to age pension, not superannuation.
Cool. Well, that's all the questions, and perfect timing with 2 minutes left. So we will be collecting all of these questions asked today, and we will be circulating them out to you all in our post-event communications, along with a recording of today's presentation for you to reflect on, and some other bits of information that we think might be relevant to you. So make sure you keep an eye out on your inbox for over the next coming days. On that note, I'd like to say a very big thank you to Katie for your awesome presentation today, and especially to everyone who joined. We hope you found some value in today's presentation. Stay safe, and we hope to see you back for future RSM events. Bye.
Yeah, thanks. Sorry, Michael, say goodbye. I just want to add something personal. Thank you very much to everyone for attending today. I have a great time doing this. Anyone that's come to our presentations know that I genuinely love talking about super. Please do reach out if you ever want to talk about anything, if you've got questions. And as Michael said, we'd love to see you at future events, hopefully in person with a glass of wine. Thank you.